Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. It is a Wednesday, and it feels like a bad news Wednesday, right? There's a lot of high-profile names coming out. We're going to talk about them on the show. We're going to trade them on this show, but a lot of we've got news in Boeing. We've got news in Starbucks and McDonald's that we'll trade on this show. Qualcomm and ARM, UPS and FedEx, though that continues. Enphase. There's a lot of names. It feels like just a bad news vibe over this market today. We had mortgage apps, down hard for a second week in a row. Not surprising with where the 10-year yield has gone to and what mortgage rates are doing. Not surprising that we've got existing home sales that were a little lighter than expected and a little lighter than last month. So that's also not surprising with where people that own homes have interest rates. Now they're higher, so they don't want to sell out of that. So not real surprising on the mortgage apps and existing home sales, but the news across the board from a microeconomic level and individual stories, it just seems like there's pressure on this market right now, and you've got a 10-year yield now 4.25. It continues to rise. The dollar now 104, almost 104.5. That continues to rise. So the dollar in yields putting pressure on the overall market, and then some of the economic data and some of the individual stories weighing on the markets right now. But let's get to them because we have a lot to talk about in these names. So the first one we want to look at is McDonald's. Now, McDonald's has news out, right? Food safety. That's the one thing you're worried about if you deal with food stocks or restaurant stocks is food safety. Remember, we've seen it in the past in Taco Bell. We've seen it in Chipotle and the problems that can go through. And first we'll talk about there's an E. coli outbreak in the Mountain West states, right? The biggest one, there's 10 overall states, 49 people, 27 cases in Colorado alone with one elderly fatality. So that's horrible news and what everyone worries about in terms of food safety. So there's things that McDonald's can do though, right? They have a footprint, a path, how to deal with this. Number one, you talk about the problem and get to the problem, and then you be extremely transparent. Don't put your defense on the field. Don't go all corporate with the lawyers. Be transparent and be completely honest with everything. And then whatever the norm is, go over and above what you can do to get that fixed and help people that and turn this horrible story around as soon as possible, because if it does drag out, it can linger on the stock. Now, when you look at the stocks movement today, the stock traded as low as 290. It's now 298. It's actually only down 5%. It was down a lot more than that earlier in the day. Implied volatility is high. Obviously, this is a big spike lower, and the day's not over. So make sure you're watching the price action here. And remember, implied volatility is high. So you have to think about a high level of implied volatility. Implied volatility is already high, so you want to sell something that's high. Buy low, sell high. We're selling high implied volatility. So the trade we looked at here was a short put vertical, right? So that gives you, we're going to look at the November 15th expiration and sell the 280, 270 put vertical. Now, it was trading about $1.60. It was then, right as we're coming on the air, it's trading about $1.30. Now it's down to $1.20. Now, you have choices there, right? There's the spread that we looked at originally, but an hour ago, half hour ago, it was trading $1.60. Now it's trading about $1.20. So what you can do is two things. You can trade it very aggressively and look for bids now and work orders, or you could put in a limit order above the market, see if the ebb and flow takes the stock lower beyond the day. And the other choice is you can scale your orders. You could sell some here, sell some a little lower, sell some a little lower. But the short put vertical gives you about 6 negative vega per spread. So you're selling high implied volatility. Doesn't mean it'll be successful, right? If the stock goes another $18 lower, you're short the 280 put out till November 15th, which is about 23 days. So you've got this on, but you are selling high implied volatility, selling a high probability short put vertical that is risk defined and collecting theta and high probability. Now, if you think McDonald's can go lower than this, and it'll depend a lot on the news flow, I think is what you really have to pay attention to. But high implied volatility, you want to look at your strategies that are negative vega. So you're looking at a high probability short put vertical here. And you choose the strikes, you choose the width. I did a $10 wide strike here. Maybe you can do a $5. Just use the risk profile on the Analyze tab of the Thinkorswim platform and figure out the right levels and play with the strikes and play with the dates and play with all those and move them around till you find the one you want. But November 15th, short 280, 270 put vertical, now trading about $1.15. Like I said, you might want to look at strikes a little closer to at the money, or maybe go out further in data. That's your choice. But the risk on this trade, remember, it's a $10 put vertical. So it's the difference between the credit received and the $10 strike. So if you sell it for $1.50, you have $850 in risk on that trade. There's always a negative trade-off when you're selling vertical spreads versus buying them. This is a short put vertical selling negative vega into high implied volatility. Now let's get to our second trade of the day, and that is the other big news, Starbucks. Starbucks came out after the bell yesterday. They released their results for their fiscal fourth quarter, and they also suspended their outlook for fiscal 25. Now that sounds like pretty bad news, but it's actually pretty normal. Why? Because a new CEO should get some latitude, some rope to fix the problems in the company. And that's what Brian Niccol, who has a great history of doing this at Taco Bell, at Chipotle, he's the fixer, right? So Brian Niccol might be the perfect person for this job. And that's why, even though Starbucks traded as low as 93.69, it's back over 96 and only down about 46 cents on the day as we tape the show. So and here's why it is. Even though, same-store sales dropped for the third consecutive quarter, a 10% tumble in traffic in North America stores. China is very weak. They're down 14% in China. So he's got North America problems. He's got China problems. But the way Brian Niccol presented this, talking about the fixes, and at the same way, very quietly, raising their corporate dividend from 57 cents to 61, that instills trust in investors. He's gonna talk about marketing the company back to customers. He's gonna talk about pricing. He's gonna get back to the growth, and he's got a plan called Back to Starbucks. So Brian Niccol doing all the right things in Starbucks, and that's why you see a muted response on the downside. Opened up much lower. It opened up, it opened 93 and change, went down to 93.69, and then has rallied from there. It doesn't trade as much as McDonald's. So what I looked at here is just a very simple cash secured put. So I went out to the November 15th, same one, about 23 days. Is that what I said? 23 days. And I sold the 90 put in Starbucks. Now, it's not a put vertical. It's just a cash secured put. The difference, the margin is different, right? You have to have the margin covered all the way down to zero, which in this case, selling the 90 put is $9,000. But what it does give you is flexibility, which means if you look at the risk profile there, the trade we put in was selling the 90 put for $1.30 credit. It's trading about $1.26, so pretty close to that same area right now. But again, this is another high probability trade that's collecting theta. It's short vega, but it has a different risk profile, doesn't it? More of a risk profile of the covered call than a short put vertical, because a little higher margin level, because you got to have the margin all the way down to zero. Can you buy a little put and control that margin? Yes, you can. But for this lesson, it's just a simple cash secured put. So collecting about $1.25, $1.30, same risk profile as a covered call. And if the stock were to go below 90, here's the key point. If the stock were to go below the 90 strike, your entry, right, into StarBucks is $90 minus the credit you took in. So if it's $1.30, you enter StarBucks at $98.70 or $89.70. $88.70. Look at me doing math live on the air. $88.70 is where you would enter StarBucks. So that is one way. And of course, as it gets closer to expiration, you can buy it in. You can extend duration on it. This is a big strategy that institutional clients use, the cash secured put. Because if it gets down there, you buy the stock. You would maybe interested in buying the stock anyway. And technically, it's a very stable level of support around $90. All right, that's our show for today, everyone. We covered McDonald's. We covered StarBucks, 2 names in the news today. Watch Daily Trader every day with Kevin Hincks. We'll be here. Have a great day, everybody.